We'd like to wish you all season's greetings for this time of year, and hopefully we presented strong performance in November, and that will add to your holiday cheer. And the markets reacted super positively to the election of Donald Trump in the US as president, and also the retention of the House of Representatives by the Republicans and their takeover of the Senate as well. The Republican Party controls all three levers of government, which provides a unique opportunity for the Republican Party and Trump himself to really direct what policies he wants to see implemented.
So Jeff has been talking about the election for us as investors and how we've dealt with that in the portfolios. Well, we positioned ourselves ahead of that to some degree because of our concerns about the level of government debt, and we were forecasting that potentially this was likely to increase under a Trump election. As we've talked about previously, we've dealt with this by investing in solutions and in cautious by holding fixed interest investments at a much shorter end of the market to take advantage of the yields there and avoid the risk of yields backing up at the longer end.
Markets rallied because they are keying off of two of the main things that Trump is going to try to do, and he named four areas that he wanted to make significant change to the US economy. One was on deregulation. He wants to make it easier for businesses to operate. He wants to encourage more domestic energy production in the US. He wants to allow more mergers and acquisitions to take place. He just wants to create a more entrepreneurial environment. Secondly, he wants to reduce taxes. He specifically mentioned lowering corporate tax rates. He also mentioned renewing the Tax Cut and Jobs Act that he passed in 2017 when he was first president. All those tax cuts are due to expire in the end of 2025. So those two things, deregulation and lower taxes, has sent a surge of energy into US equities and produced pretty broad-based rallies. It wasn't just the Mag 7, it was other areas of the economy doing well.
The outcome of a Trump and a full Republican sweep has led to a widespread expectation for an increase in the deregulation of US industry and a decrease in the interference of government agencies in business. We view these as positive for US industry and US business, and in particular the banks following the 2008 great financial crash, the number of restrictions were placed on them, their ability to lend, and how much capital they had to keep on their balance sheets. After the election, we saw a significant rise in the valuation of the holdings we have in those sectors. Following that and the outcome of the election, we've increased exposure by adding some smaller and mid-sized US banks into the portfolios, which we believe will be key beneficiaries of the further deregulation in this sector. The technology sector, we increased our weightings there, and again with the decreasing government interference, we believe there'll be greater motivation for these stocks to do well, and also we potentially will see some greater mergers between competitors as they seek to focus on a more security of chip manufacture against rivals in China and elsewhere.
Enthusiasm for equities did spill over to other markets. The only markets that stumbled really were Japan and Europe, and Japan called a surprise election, and the result was a even weaker government than they had before the election. So I think that produced some negative price movements in Japan. And in Europe, Germany, which has been the weakest economy all year in the Eurozone, they also called a surprise election for next February, and I think that weighed on the German market. And also, there are fears of Trump implementing tariffs, and that's probably the third point I want to talk about of his four things he's focusing on. Trump wants to use tariffs on countries that export goods to the US to change their behavior. In the past weeks, he has blurted out the threat of 25% tariffs on goods from Canada and Mexico and 10% more on China. In exchange for not putting those tariffs, he wants Mexico, China, and Canada to control the import of fentanyl into the US, and also in the case of Mexico and Canada, limit undocumented aliens getting into the US. And he has gotten an instant response from Mexico and Canada. He's spoken with the president of Mexico. The suggestion is that Mexico is going to do something to reduce border crossings and maybe reduce drug cartel influence in shipping drugs across with those border crossings. In Canada, Prime Minister Trudeau flew down to see Trump in Florida and try to tell him that there aren't a lot of illegal immigrants coming across from Canada, nor is there a huge surge of illegal drugs coming that way as well. China was more circumspect. We don't know where that's going, but there is a fear that Trump is going to keep blurting out large tariff announcements as punishment for countries that aren't doing the right thing. And Germany is clearly in the crosshairs as they are a country that runs a large trade surplus with the US.
The other sector which we've invested in, which has until recently not performed particularly well for us, was defence stocks in Europe. As Jeff mentioned, Donald is looking for a quid pro quo for not imposing tariffs. For Europe, it's been a constant theme. It was one from his initial term as the president, that he didn't believe Europe was doing enough in terms of spending on defence and was getting a free ride from the US. With the election of Donald Trump, we've seen a significant rally in European defence stocks as European countries are now committing more of their GDP to defence expenditure than they have done since the 90s. This has performed particularly well for us, an area that we believe will do well as we see the order books increasing and expected cash flow to come from these sectors will be advantageous to shareholders.
Trump is also much better organized this year than he was in 2016 when he first won. He has already named all the people he wants in his cabinet.
Elon Musk has been appointed as the head of Department of Government Efficiency. We see this as a key theme within the Trump administration and the Republican administration per se. We've seen a number of heads of various agencies already looking to resign or to be replaced by Trump appointees. And again, the reduction in this expenditure is a key area that we think will drive more activity in the US business and industry as the deregulation across various areas comes through and less interference from government agencies.
The key thing is Trump is focused, he's putting loyalists in place, and he is going to have the next 2 years before the next midterm elections to try and make significant change in the US. Near term, Trump is going to be seen as very, very positive for business, but he is also a very volatile character. And I think the markets will continue to show greater volatility because of the nature of his policy making and policy announcements. But I think we're feeling good about the environment into next year. In addition to the election, the Fed cut rates in November again. The Bank of England cut rates again in November. The ECB, while they had last cut in October, gave strong hints that they will cut this month. So inflation remains contained. Energy prices keep sliding lower. That will help, I think, keep inflation contained, keep real incomes growing. Labor markets remain tight. So the backdrop is very good for growth and risk assets. And then throw on top of that a Trump who is trying to energize or further energize an already strong US economy. And I think we have the recipe for some further gains in risk assets in the months ahead.